This will shock the economy. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, the U.S. economy is now weeks away from nosediving into a hard landing. Let's over to the Wall Street Journal, where we picked today's story up with the headline, student loan repayments are coming back, and retailers, well, they're in for a big shock. And this comes out just after we talked about the retail sales report yesterday, which showed that on a year-over-year change, it was flatlining, demand was slowing, but there was optimism, again, due to pent-up demand. But all of this leftover stimulus money would likely take retail sales higher into the end of the year, and we were making the case that it was heading lower. But what I want to suggest to you today, that as these student loan repayments come back, it's not just when they start, it's going to actually see a slowdown retail sales ahead of that, as people make major adjustments to their budget. Around 43 million people in the U.S., some 17% of the adult population have federal student debt. And out of those borrowers, roughly 26.6 million, or 10% of the adult population, had loans in forbearance as of the first quarter, according to the National Student Loan Data System. This was thanks in part to the federal government's suspension of payments and interest accrual starting in March of 2020. That pause is ending August 30th, of course, as we know, due to the debt ceiling. So now in September, everybody's going to have to start making payments again. Now, for some people, these payments aren't very big, but for other people, they're rather large. And when you factor inflation being higher, we see rents being higher, energy prices being higher, food costs being higher. Now, all of a sudden, people are going to have to adjust their budget back because they've been going a long time without making these payments, and even worse, at a time when credit card interest rates are about to head even higher. The hit to household cash flows as a result of the resumption could be substantial, as Bank of America estimates it could be around $180 a month for the median impacted household. In a 2017 survey conducted by the Fed, the median monthly student loan payment was $222 and the average was $393. While estimates vary, not even on conservative expectations, borrowers are set to collectively resume paying $5 to $8 billion a month once the pause is lifted. Some research outfits, including JP Morgan and TD Cowen, place the number close to $10 billion a month. And so this is substantial. So you start thinking about, where are people going to redirect their spending to pay on these student loans? It naturally has to come out of discretionary spending, because you're not going to stop paying for your rent. You're not going to stop paying for food. You might cut back your energy usage some, but you still have to pay that bill as well. So all of a sudden, we're going to see discretionary spending, which is now going to impact retailers in a huge way and drive that year-over-year rate of change into the negative, putting retailers in even a bigger problem they have now. They're already overloaded in inventory. They're already seeing slower sales. Their costs have gone up due to inflation. What they need is sales to go up, and then what they're going to find out is they're going to head down, and it's going to put even more people on the unemployment line. According to Fed and Equifax, more student loan borrowers now carry more credit card debt and are less likely to have an emergency fund compared with the average American. So even worse, we talk about the impact of the higher federal funds rate on credit card debt, and usually it takes about 2 months after the Fed raises rates before we see the minimum payment, that interest rate on credit cards rise. Now, the Fed didn't raise rates this week, but they raised them last month. So that means in the following month, we're actually going to see that impact credit card borrowers at a time when they're already staring down the pipe and saying, hey, you know what? I've got to start adjusting my budget to pay that student loan payment, and now my credit card payment went up as well. America's analysis of its credit and credit card data, what's more, the share of credit card loans transitioning into serious delinquency have surged more sharply over the past year for borrowers aged 18 to 29, followed by those aged 30 to 39. So not only are we facing a problem here that people are not going to be able to make their credit card debt because their payments going up, we already have people right now in delinquency. So now all of a sudden you think about, let's tack on their student loan payment on top of that, and what's going to happen to the economy? It's going to grind to a literal halt, but it won't take that time to September, because again, people are already going to have to adjust sooner. You're going to see spending start to slow down in July and August. At some point, people are going to make their last big push to get what they can, and then they're going to have to seriously adjust their budget. They're going to get their next credit card bill. Jaw's going to drop when they see their minimum payment went up, and it's going to be a massive adjustment that will outright shock the economy. And younger people are facing a steeper rise in rent and mortgage payments to make things even worse, since they tend to move more frequently, whether for work or to accommodate expanding families. All of that makes it very likely that the more than 20 million consumers sent to resume student loan payments will cut back, as I just said, on discretionary spending come September. I'm going to suggest, and love to know what you think. Do you think that people will wait till September, or do you think they'll start cutting sooner? I think they're going to start cutting even earlier than that, perhaps even in July, but we'll see for sure, because here's what's going to happen to retail sales. As we look at this chart going back from yesterday, you can see the year-over-year rate of change is virtually at the zero bound. It's very close to that, but you can go back to the dot-com bubble and say, well, it didn't go negative during that recession, but look what happened during the global financial crisis. What we're setting up is for retail sales now to already go negative before we hit a recession, or perhaps maybe even we'll see a simultaneous recession around that time, if arguably we're not already in one sooner. And global rate hike endgame is now haunted by recession worries, as policy makes may transpire as central bankers are focused on inflation. But one thing you shouldn't have a policy mistake with is your trading account. Remember, if you had CTA-Timer Pro, you've been participating in this tech rally in a big way. It gave you some signals to buy here. It gave you the signals to buy here. In fact, I got an email from a subscriber just the other day. He said, you know what? There were 3 symbols. He said, I've never traded this before. I watched your report. I saw how to use it. I waited patiently. He said patiently to let the trade set up. And as soon as the machine report positioning said it started short covering, he says, I just bought all 3 of them. He's like, I'm amazed. It worked so well. It was so easy. And what is he talking about? Well, every day you get a report that shows the machine positioning, but we adjust it based on a historical basis, which makes this thing even more amazing. And he saw that whatever he was trading, we're at 100% short across both the fast and slow algorithm. He waited till the machine started short covering. He started buying, and it worked out well. This report from January 9th on the NASDAQ, we showed you then you could be buying it at that low. And then again on the pullback at March 15th. My friends, one of the easiest reports is $30 a month. I know we're going to be raising the price pretty soon to 40, so get it while you can. Lock that price in. And again, there's always a 30-day money-back guarantee if you're not satisfied. With the Federal Reserve Chair Jerome Powell flagging a potential further half-point increases in his European Central Bank counterpart, saying another quarter-point step is very likely, a pivotal week in monetary calendar has left financial markets starting to count the cost of that incessant tightening may inflict. And if they continue to do so, which will make the case that the Fed really is getting to a point where now they've said they're going to skip. The reality is they're almost going to be forced in a pause position. We can kind of make the case, and we will make it in later in the show, that inflation is going to come down even more between now and the next meeting. And even though the Fed's talking about another 50 basis points, there's 2 factors I want you to consider. One, it's going to put these credit card minimum payments up even more at the worst possible time. Because remember, a 2-month lag, you start to get a hike right before that September payment. It's going to be a double whammy. But what about the banking system? We know this inverted yield curve is just a death knell to the banking system. The Fed keeps hiking. It's only a matter of time before we see a next big round of bank failures, and the Fed chasing the funds rate back to 0 faster than you can blink. And signaling skepticism that policymakers can avoid a U.S. recession, which is many things, yields on the U.S. and 10-year German bonds are trading well below the rate on 2-year securities, indicating that the curve is inverted, as we just talked about. The Treasury's curve slightly deepened its inversion on Friday near levels seen in early March, just before the U.S. regional banking crisis roiled the global markets, and 2-year yields rose a little bit. But let's take a look at what's going on and what this means for retail sales, because on the onset, the U.S. economy is slowing down. And why does this matter? Why does this inverted yield curve have anything to do with retail sales? Well, it's simple. Banks borrow at the short end of the curve and lend at the long end. So when the short end of the curve is higher than the long end, they don't make money lending. They lose money. So guess what they do? They don't lend. They tighten lending standards, and they start cherry picking who they want to lend money to. Now, we know they haven't overly tightened data on the credit cards yet, and I'm going to show you that here in a moment. But what happens is when credit gets harder and harder to access, well, how does that transmit to retail sales? Well, it means people spend less. And if they have student loan repayments and higher credit card payments coming as well, you can see the spending is going to go down a whole lot more. And here's the data that validates that. Here we see the yield curve in red, and anytime it's below that horizontal black line, it shows inverted. And we got retail sales there, and you can see the inversion. And look at that, retail sales start to slow down as the curve steepens and retail sales stay muted. They're coming out of the dot-com bubble. How about going to the global financial crisis? We get this nice little inversion here. Retail sales are coming down, 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 and then plummeting. And here we can see it again. We see this big, deep inversion, retail sales slowing down. Again, this is all about credit, because we look at the number of domestic banks tightening standards for credit cards. Now, we don't have a ton of data on this, but we can go back and look at the global financial crisis and see just how much banks tighten standards there. All it means all the way up and all the way down. That led to a big drop in retail sales. We saw it during the pandemic. We're seeing it again now. And when you start thinking about, well, what does that mean in terms of tightening standards? Well, it means it's harder to get a new credit card. It means they don't want to raise your limit. And when people get tapped out on their credit, that's what I've really been waiting for, is to see when the consumer maxes out, hits the red line of their credit card, what happens next is they'll have to stop charging, start paying them down, and another hit to discretionary spending, adding to already the big pile that's coming at the end of the year. And central banks collectively now seem to think that higher rates are still warranted, even though their economies are softening or about to collapse into a hard landing. And here we can see policy mistakes could well be unintended results. Well, I don't know what you think about that. I mean, that's just kind of a great statement. So, you know what? They believe they're doing the right thing, but they remain completely clueless, because raising the funds rate and inverting the curve and destroying your banking system all at the same time is not a smart idea. That is what you call a policy mistake. The only question I don't understand is how clueless these central bankers are to the system that they're supposed to know the most about and are in charge of managing. And here we can see that retail sales last month exceeded nearly every estimate, but the reports show that consumer demand had moderated, as we covered in yesterday's show. We talked about factory production remaining sluggish, and applications for unemployment held at their highest level since late 2021. But a surprise jump in the jobless rate last month suggests a sea of change may be underway, and I've been making this case that this is coming. Still, it's clear that a wide range of outcomes is plausible, from essentially no increase in unemployment to so-called immaculate disinflation to recession of moderate severity. Well, look, the reality is we are going to see a deflationary shock. It is inevitable when you see these yield curves so inverted. But let's take a look again. We looked at this yesterday at what happens when retail sales meet rising unemployment claims, and these charts almost look like mirrors of each other. You kind of move out of these pandemic spikes and it looks very close. But what do you see here? As the 4-week moving average initial claims goes higher, retail sales come down. You see it in the global financial crisis, the same dynamic. You're seeing it now because for one very simple reason, and we keep talking about this, is people on unemployment have less income. So they already have higher rents, higher energy, higher food costs, higher credit card payments, now higher they're going to have student loan payments. They're going to have no discretionary spending left if they lose their job. It's only a matter then before we see these debts go into delinquency. We see them then have defaults at a time when the banking system is already in dire shape. But don't listen to the Fed, because they're saying the Fed's barking comfortable with doing more to slow the resilient U.S. economy. He wants to avoid 1970s repeat. Well, don't worry. We're not going to be your problem at all. He says, I recognize that creates a risk of more significant slowdown or a massive, gigantic crash. But the experience of the 70s provides a clear lesson. If you back off inflation too soon, it comes back even stronger, requiring the Fed to do more, and even with more damage. And that's not a risk I want to take, because the Fed does not have any clue of what causes inflation. We've shown you before. Here is the default standard of what takes gasoline prices against the consumer price index, probably the best metric to tell you where inflation is going. And this is not a year's 1970s repeat, not even close. Nothing even looks like it. The red line would be going the opposite way. So what we see is gasoline prices on a year-over-year rate change telling us consumer prices heading down at this current level. If it gets down here, we're probably around inflation around 1%, maybe 1.5%. No signs that anywhere the Fed is going to have to worry. Well, they're going to have to start cutting. And we take a look at advanced retail sales against the consumer price index. What do we see? That as retail sales fall, and I know this is shocking as well, but as people spend less at retailers, That means demand falls, and then what happens to prices? Well, these retailers can't keep raising them. If they can't move inventory, prices start to flatline. Maybe they start to discount them to clear out that inventory. Now you make the case of why even retail sales starts to flatten out, causes inflation to come down. If it goes negative, as we now can expect later this year, that's highly deflationary to the CPI. And what you can note is the blue line leads, that's retail sales, leads the consumer price index often to the downside, suggesting that indeed inflation, my friends, is coming down. But there's more evidence of that. We got the University of Michigan preliminary results for June of 2023. We see consumer sentiment actually rose a little bit here. Current conditions rose, and inflation or consumer expectations rose as well. We will say that in a matter of months, these numbers are going down a whole bunch, but also they noted inflation expectations receded for the second consecutive month. We'll look at that in a moment, but here's why sentiment matters. Here we have advanced retail sales in blue again against the University of Michigan consumer sentiment. This is not showing the preliminary data. It only shows the final data. We'll have that in 2 weeks for June. And what do we note here? That in periods where you see sentiment below that black line, where it is not in a good place, that means retail sales come down, because what's happening is consumers aren't confident in the economy for any number of reasons. When they're not confident, well, they don't spend. When they don't spend, prices come down. And how about inflation? Well, here we can see the University of Michigan inflation expectation in blue against the U.S. Consumer Price Index in red. And here what we're seeing, while the inflation expectation chart is a noisier version of what we see in the Consumer Price Index, the overall trend remains lower here, except for this little bit of a rise here. Is that unusual? No, you can see that, of course, inflation expectations are rather noisy, but the trend is telling us that indeed inflation is coming down. And when you see the student loans come back, it's going to be a massive shock to the economy. It could likely send us into a deflationary spiral, putting the Fed back to zero, as I said, faster than you can blink. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.